Okay, everyone, welcome back to another exciting chapter of Principles of Banking. This time we're on to Chapter 10, which is on financial reporting, bank investments, and performance. So let's go ahead and dive right in. Now, the first section the book talks about, and that you'll want to become familiar with, is the annual report. The annual report is a document put together by banks with a wide range of information for investors, employees, regulators, and the like. Anyone who has an interest in what's going on with the bank will want to take a look at the annual report. The report contains promotional information, analysis, financial statements, and an audit report, which is given a written statement by outside auditors and accountants that details that the information can be trusted. Now, one of the primary important statements in there is the statement of condition. This picture here is of a simplified statement of condition provided by Park National Bank, but the one in the book on page 223 is much more in-depth and much more typical for what a large bank or medium-sized bank even would have, either internally or externally. Locally, Mount McKinley Bank provides a statement of condition on their website, which is sort of simplified but more detailed than this one, and gives a nice snapshot of what's going on with the bank. Now, I am going to skip over the profit and loss statement and the income statement portion of this chapter. There's a great Khan Academy video in Blackboard for you to review that if you're interested. But why is this information important? Well, this information is important to shareholders and investors. They want to know how their investment is doing. Regulators are interested in this information because they want to know that depositors' money is safe. Other banks are interested because they like to see how they match up on a peer-to-peer analysis. Customers are interested. They are interested in how their money is safe, their deposits are safe. And of course, employees are interested because, well, if the bank's doing well, they should anticipate raises, bonuses, or other types of benefits from a good performance. Next up is the management of bank funds and the risks associated in the banking business. Now, on page 229, Exhibit 10.4 lists these different types of risk that are associated with banking. Credit risk, interest rate risk, liquidity risk, price risk, operational, compliance, strategic, and reputational are all things that could risk current or anticipated earnings or capital. With a rate risk, it's from the risk to those earnings from movements in the interest rates. If we fix a rate at 6% today and 2 years down the road, prime rates at 8%, well, that's a risk because we could be losing anticipated earnings in the future by fixing rates at a certain amount now. So asset and liability management, or what's called the Asset Liability Committee, or the ALCO committee at a bank, is responsible for managing a strategy to manage funds and to take into account the many variables that come with managing a bank's money. So what are the objectives of this funds management? Well, there's three main objectives. Liquidity. Liquidity is very important because the bank needs to have money available when depositors make withdrawals. If the bank does not, that is called a run, or it could be turned into a run on a bank where there is no money available for depositors and the bank could fail. The other one is safety. Depositors have to be confident that their money is safe. And while the FDIC has an insurance policy on their funds, really it's the bank's responsibility to manage the safety of bank assets. And then lastly, but not least importantly, is income. The bank's ALCO committee, their management, and employees are responsible to make sure that the assets the bank has generates income. And one of these goals is maximizing asset return. or maximizing a return on assets, and is the money that the bank makes based on the assets they have available. One question is loans versus investments. Banks can make money, mostly they make money versus loan interest by loan interest income, but they can also make investments that can generate income, separately. And something to consider when you're thinking about this is credit risk versus market risk. Now, credit risk is basically the risk that the borrower's not going to pay on their loan. But if you invest in a security on the market, then there's a risk that it's out of your control. The market could change. You could lose some money based on, if you have a 401k right now, you know that there's market risk in those funds, and you could lose some of that money. So asset management continued here, or we call it asset return continued because we're getting a return on our assets. One of the things to consider is the loan interest. And there's a lot of things to consider when talking about loan interest. First is cost of funds. And cost of funds refers to how much deposits cost the bank in the interest paid on them, and in the providing of services to customers. So you think about it, a deposit goes in, there's interest paid out on the deposit, but that's not the only cost incurred by the bank. There's also the cost of employees, utilities, managing all of these different systems, paying for the mailing of statements, and all sorts of things. So cost of funds is a big part of it. Right now, cost of funds are low because the interest rates being paid out on savings accounts are low. But that is still a consideration. The other one is the availability of funds. One thing the bank has to do is make sure that they have available funds in their capital to lend out. There's also risk factors. In commercial lending, for instance, we analyze our customers and our borrowers individually for each loan, and we attach different terms and rates based on the risk associated with those loans. And then there's the term, how long the borrower is going to have to repay, how much time and what function are we going to allow them to repay. Basically, the longer the term, the more risk there is. If it's 60 months, there's less risk. If it's 120, there's a lot more. There's 5 more years for something to go wrong, and those loans are usually priced accordingly. And you may have noticed this when you've bought a car. If you buy a car and you're willing to repay the loan in 36 months, well, hey, you're going to get a smoking deal. But if you're willing to repay it only in 84 months, well, there's going to have a lot more of a rate in there. Same thing with mortgages. The shorter the term your home loan is, the lower your rate generally is. So market rates, as they apply to lending, there's a few different things here. The discount rate, this is the interest rate the Federal Reserve charges for the short-term use of Federal Reserve funds. The prime rate, in the book is called the prime rate. Most banks use the Wall Street Journal Prime, and that's just the prime rate that's published daily in the Wall Street Journal. It's generally accepted as a prime rate. The federal funds rate, now this is the rate that one bank charges another for overnight use of reserve funds to bring the bank's reserves up to the funding requirements for the day. It's sort of a complicated arrangement, and it's not really necessary for us to go deep into this, but just know that this rate is out there, and it does affect the availability of rates in the market. And then there's LIBOR, which is the London Interbank Offered Rate, and this is an international money market rate that pretty much is the average rate that banks offer each other, in the placement of euro dollars. So, there was a big scandal not too long ago with the manipulation of the LIBOR rate, and several bankers in London got in some pretty big trouble about it. Okay, types of bank investments. Now, banks are not allowed to invest in individual stocks right off on themselves, but they can invest in several things. There's U.S. Treasury securities. A lot of banks will invest in that. Treasury bills, Treasury notes and bonds. And TIPS, which is the Treasury Inflation Protected Securities, which have a variety of maturities, and they basically are low risk and low reward note that the banks can use to manage their funds risk against inflation. And there's also government agency securities, which are protected by the government, and they yield higher interest rates than obligations, but they tend to have the same maturities. Two types of these are mortgage-backed agency securities, which tend to run by Fannie Mae, Freddie Mac, Ginnie Mac, Ginnie Mae, and then there's non-mortgage-backed agency securities. Banks can invest in municipal securities, which are bills and bonds similar to the federal treasury ones, and then non-governmental securities, which tend to have some more risk, and you can review the book for some more information on that. Another type of income that the bank loves is fee income, and I say that the bank loves it because there's generally not much risk associated with fee income, perhaps some risk to competition if your fees are sort of outrageous. But these are easy ways to generate income or non-interest income, in bank parlance. But these are not just NSF fees. There's a myriad of other fees for services, fees for statements and check images and research and auditing accounts and all types of fees. My personal favorite are loan origination fees because I'm a lender, so those are fees that we can have a direct impact on when we're writing our loans. But something that's interesting about loan origination fees is that loan origination fees are subject to FASB, or Generally Accepted Accounting Principle rules, which says that they must be recognized over the life of the loan. So on the bank's books, they cannot recognize loan fees all in the same year, typically, unless the life of the loan is a year or less, or the bank sells the loan to, in the case of mortgages, we would sell the loan to a third-party investor, and then we can recognize that fee income right away. Performance measures. I'm not going to spend a lot of time discussing how these ratios are calculated, but it's useful to know what they are and why the bank pays attention to them. So here's a few of them. Return on assets, or ROA, measures how well the bank uses its assets to produce income. Return on equity measures the rate of return relative to the funds invested, or equity, in the bank. So ROE for most banks is about 10%, but in 2009 it was far lower than that. The capital ratio measures the stability and strength of the bank. Bank capital ratios are normally 6% to 8%, although some banks have been trying to capitalize a little bit more. Net interest income defines the difference between interest earned on loans and the interest paid on deposits. The higher the amount, the greater the profit. And then earnings per share. This is basically how many dollars of net income there is per number of shares outstanding. And the book also talks about budgeting and planning, which is sort of a way to measure goals, plan for the future, and then measure your progress against the plan. Most of you probably are sort of familiar with budgeting and planning, so we're not going to spend a lot of time on it. And then lastly, our favorite section with Chief Wiggum here, laws and regulations. There are several laws and regulations that manage the way that banks' financials are reported, but none more than GAAP, or the generally accepted accounting principles. There's also regulatory reporting and other reporting laws outlined in the book. Again, not going to spend a lot of time on it. Review the book. There may be a couple of questions about them throughout the rest of the semester, but again, there's a ton of laws and regulations in banking, so that's the way it is. So that's Chapter 10. Over and out. Everything good to go there, so stay tuned. Watch the Khan Academy video, and I hope that you enjoy it, and we'll talk again soon.